Day 12. So we'll start the bond market 2.2 today. So let's begin. The bond market is composed of long-term borrowing or debt instruments, then those that trade in the money market. This market includes treasury notes and bonds, corporate bonds, municipal bonds, mortgage securities, and federal agency debt. These instruments are sometimes said to comprise the fixed income capital market because most of them promise either a fixed stream of income or a stream of income that is determined according to a specific formula. In practice, these formulas can result in a flow of income that is far from fixed. Therefore, the term fixed income is probably not fully appropriate. It is simpler and more straightforward to call these securities either debt instruments or bonds. So, let's talk about treasury notes and bonds. The US government borrows funds in large part by selling treasury notes and treasury bonds. T notes are issued with maturities ranging up to 10 years, while bonds are issued with maturities ranging from 10 to 30 years. Both notes and bonds may be issued in increments of $100, but far more commonly trade in denominations of $1,000. Both notes and bonds make semi-annual interest payments called coupon payments, a name derived from the pre-computer days when investors would literally clip coupons attached to the bond and present a coupon to receive the interest payment. Figure 2.3 is a listing of treasury issues. The bid price of the highlighted note, which matures in May 2019, is 99.8125. This is the decimal version of 99 into 104 by 128. The minimum tick size or price increment in the treasury bond market is generally 1 by 128 of a point. Although bonds are typically traded in denominations of $1,000 par value, prices are quoted as a percentage of par. Thus, the bid price should be interpreted as 99.8125% of par or $988.125 for the $1,000 par value bond. Similarly, the ask price at which the bond could be sold to the dealer is 99.8281% of par or $998.281. The minus 0.0859 change means that the closing price on this day fell by 0.0859% of par value, equivalently by 11 by 128 of a point from the previous day's close. Finally, the yield to maturity based on the ask price is 0.933%. The yield to maturity reported in the last column is calculated by determining the semi-annual yield and then doubling it, rather than compounding it for 2 half-year periods. This use of a simple interest technique to annualize means that the yield is quoted on an annual percentage rate APR basis rather than as an effective annual yield. The APR method in this context is also called the bond equivalent yield. We discuss the yield to maturity in more detail in part 4. So here we have the figure 2.3 listing of treasury issues. We have the maturity dates and the coupon, the bid, the asked, the change, asked yield to maturity. So we'll figure out what all this means. Like we can read it and we can read the graphs and the tables and everything, but we'll truly understand. And when I say we'll, I mean me. So I'll truly understand what they mean when I do the questions, because all this is very like formula based and numbers based. So just by reading it as like a paragraph, you don't really like understand it and doesn't get through your head. But when we'll do the questions and the problem sets at the end of the chapter, and when we'll write it, in a notebook and solve it, then we'll understand 100%. I have no doubt. So yeah, instead of reading it over and over again, I'll just like read it one time properly, and then I'll have confidence in myself to understand it later when I attempt the problem sets. And even if I don't, I'll take help. I'll look online and stuff. So yeah, and even if I don't, then I'll ask my father to explain it to me. So yeah, concept check 2.1. What were the bid price, ask price, and yield to maturity of the 2% August 2025 Treasury bond displayed in figure 2.3? What was its ask price the previous day? So we're talking about this one right here, and it's asking what's the bid price, ask price, and yield to maturity. So the bid price for this one is 02 point, wait 1 second. Okay, yeah, so the bid price for this one is 102.2813. Okay. Okay. So yeah, so the bid price is 102.2813. So that'll be like percent. So if it's $1,000 bond, then it'll be, 1,000, 1,022.813 is what I'm guessing it is. And then we have the ask price. Ask price is 102.2969. So as we can see, the ask prices are slightly higher. So the bid ask spread is the trader's profit. So that is that, and then that'll be $1,000 and $1,022.969. So that's that. And then we have the yield to maturity. That would be 1.730, I'm assuming. Yield maturity based on 0.933. Yeah, so 1.730 will be the yield to maturity of the 2% August 2025 Treasury bond displayed. And ask price the previous day. Oh, so maybe the change is the per day change. Closing rate fell by. Okay, so this change is minus 0.3438. So the ask price the previous day. Okay. So basically, if you put this in a calculator, this is a reduced version. So the previous ask price, let's say that's x minus this current price, x dash by x is equal to minus 0.3438. 3438. Basically, that's what it says. And I don't really know how to find that, but yeah, we'll just move on. So inflation protected treasury bonds. One second. So here we have the solution for the first one. So bid is this one, this is right, then this is right, this is right, and the ask price decrease from The ask price decreased 0.3438 from its level yesterday. So the ask price then must have been 102.647 or that. Okay, I don't know how they found that, but let's just do this quickly. We have 15 more minutes left, so it's fine. Yeah. Okay. So basically what we need to do is we need to do this 1 minus 0.3438 is 0.65. Oh, no. So 0.3438 percentage. So 0.003438. So 1 minus 0.003438, that is 0.996562. So 0.996562 times, now we do times the current ask price, which is 102.2969. So we get oh, this is wrong. So wait 1 second, let me try again. So we got 101. 1 second. 0.3438. 1 minus 0.3438. 0.6562 times. That'd be too low though. Yeah, there's no way. 102. See? Yeah, that's not obviously wrong. But decreased 0.3438 from its level yesterday. So decreased. Oh, we need wait. Divide. Did I not divide? I did divide. 1 second. Okay, so 1 minus 0.003438, 0.996562. So okay, 0.996562. 0.996562. 0.996562. 699.996562. 102.649. Okay. I mean, I got 102.64, so yeah. Okay, I got it. So basically, So basically, what we did was 1 minus 0.003438. That was 0.996562 or something. Let me just double check again. 6562. Yeah, 0.996562. So then what we do is we divide the current ask price by that to find the previous ask price. .996562. Yeah, 102.6498. I'm getting. It's close, but it's not exactly the same actually. So I don't know about that, but yeah. Theirs is 102.6407. Mine is 102.6498. So I mean, it's making a pretty significant difference because when you apply that to like hundreds and billions of dollars, it makes a large difference. So yeah. Anyways, let's move on to inflation protected treasury bonds. The best place to start building an investment portfolio is at the least risky end of the spectrum. Around the world, governments of many countries, including the United States, have issued bonds that are linked to an index of the cost of living in order to provide their citizens with an effective way to hedge inflation risk. 1 second. In the United States, inflation protected treasury bonds are called TIPS, Treasury Inflation Protected Securities. The principal amount on these bonds is adjusted in proportion to increase in the consumer price index. Therefore, they provide a constant stream of income in real inflation adjusted dollars. Yields on TIPS bonds should be interpreted as real or inflation adjusted interest rates. We return to TIPS bonds in more detail in chapter 14. So, uh, Treasury protect security is a principal just in proportion to the consumer price index. Okay, federal agency debt. Some government agencies issue their own securities to finance their activities. These agencies are formed to channel credit to a particular sector of the economy that Congress believes might not receive adequate credit through normal private sources. The major mortgage related finance agencies are Federal Home Loan Bank FHLB, the Federal National Mortgage Association FNMA or Fannie Mae, the Government National Mortgage Association GNMA or Ginnie Mae, and the Federal Home Loan Mortgage Corporation FHLMC or Freddie Mac. The FHLB, Federal Home Loan Bank, borrows money by issuing security and lends this money to savings and loans institutions to be lent in return to individuals borrowing for home mortgages. Although the debt of federal agencies was never explicitly insured by the federal government, it had long been assumed that the government would assist an agency nearing default. Those beliefs were validated when Fannie Mae and Freddie Mac encountered severe financial distress in September 2008. With both firms on the brink of insolvency, the government stepped in, putting them both into conservatorship and assigning the Federal Housing Finance Agency to run the firms. However, it did in fact agree to make good on the firm's bonds. International bonds. Many firms borrow abroad and many investors buy bonds from foreign issuers. In addition to national capital markets, there is a thriving international capital market largely centered in London. A Eurobond is a bond denominated in a currency other than that of a country in which it is issued. For example, a dollar denominated bond sold in Britain would be called a Eurodollar bond. Similarly, investors might speak of Euro yen bonds, yen denominated bonds sold outside Japan. Because the European currency is called the euro, the term Eurobond may be confusing. It is best to think of them simply as international bonds. In contrast to bonds that are issued in foreign currencies, many firms issue bonds in foreign countries, but in the country of the investor. For example, a Yankee bond is a dollar denominated bond sold in the United States by a non US issuer. Similarly, samurai bonds are yen denominated bonds sold in Japan by non Japanese issuers. So, a whole lot of semantics there. We're just talking about what bonds are called based on where they are sold, which currency they're sold in, who sells them. So, a lot of details there. So yeah, samurai bonds is kind of funny though. But yeah, municipal bonds are issued by state and local governments. They are similar to treasury and corporate bonds, except that the interest income is exempt from federal income taxation. The interest income also is usually exempt from state and local taxation in the issuing state. Capital gains taxes, however, must be paid on munis while the bond mature or if they are sold for more than the investor's purchase price. General obligation bonds are backed by the full faith and credit, that is, the taxing power, of the issuer, while revenue bonds are issued to finance particular projects and are backed either by the revenue from that project or by a particular municipal agency operating the project. Typical issuers of revenue bonds are airports, hospitals, turnpike, or port authorities. Obviously, revenue bonds are riskier in terms of default than general obligation bonds. Figure 2.4 plots outstanding amounts of both types of municipal securities. Figure 2.4 tax exempt debt outstanding. So, this is the amount of debt that can't be taxed by the federal government, basically, or state, or local. So, exempt from taxes. Um, we have general obligation bonds, and then we have industry revenue bonds. Okay. Oh yeah, so here we're talking about basically in municipal bond you have to pay taxes on interest, but if you sell the bond for more than what your original purchase price was, you have to pay a capital gains tax. So that sucks. But except that, it's a pretty good deal. You get a safe asset in which you get an interest and you don't even get taxed. So that's good. So yeah, now we actually I don't know whether I should keep going because then it gets pretty complicated and we don't have time right now. So I think we'll call it at that. Page number 35 today. So yeah, not bad. Day 12, 35, not even 35 actually. 1 second. Let me see how many pages we've done actually. Okay. Yeah, 35 pages done. That's pretty good. 35 pages in 12 videos on average, which are like 20 minutes, 25, 30 minutes. That's pretty good. That's only 6 hours, give or take. So in 6 hours, we did 35 pages, including questions and everything. So, I mean, we have about 965. So if we say times 665 times like say 30-minute videos, by 1 second, so 35 videos in 35 pages in So yeah, we can't really make projections like that, if we did 35 pages in 12 videos, 30 minutes average time. So how long how many videos is it gonna take to finish the whole book? We can't really make projections like that because we don't know how hard the questions are going to be, how hard the concepts are going to be, how much time you're going to take to understand those set concepts and questions, so we don't really have an idea. So it's a very, this could take anywhere from 3 months to a year. So we really don't know. So I'm hoping that I can finish this as soon as possible with all the concepts grilled in my mind, so that I'm happy and I've learned a lot, and I can start my CFA prep confidently, and that I know that this is something that I can do, and also prove to myself that I can commit to something, in this case reading a book and understanding all its concepts and practicing questions every day for hundreds of days or whatever. I just need to prove that to myself that I can do that. And yeah, that'll make me happy. But anyways, we are done for today. Municipal bonds, we just started. From tomorrow we'll continue with it. and there's some formulas here as well, and graphs and everything. So that'd be interesting. Yeah. Anyways, thanks. I'll continue tomorrow with day 13.